Well, the odd thing about all this, when you look at the actual sort of satellite data for oil supply, it seems like there's not actually much more oil coming out of OPEC right now than there was a couple of months ago. Output's up slightly, and I know this is supposed to get phased in, but when you look at this group of 8 countries that voluntarily cut and now are bringing back on production, a lot of this looks like it's more sort of paper barrels than actual real supply. So the paper market responds to paper barrels, as we've seen the price fall in response to these numerous headlines. But there's not really a lot of evidence that the physical market is being affected, which you can track through tanker rates, you can track through storage costs, and you can track through refining margins. And each of those are actually signaling a pretty tight oil market. So again, I see all the headlines, which are all very negative, and the Bloomberg headlines in particular are very bearish, and everyone's out there talking about $40 or $50 oil. And honestly, if OPEC can bring on more barrels from a paper perspective like they are and not glut the physical market, we could be in a couple of months talking about $80 plus oil rather than this sort of persistent bearish narrative that you're seeing in headlines.
So, Josh, what is the message to global oil market investors right now? Is it keep calm and carry on and trust the OPEC strategy?
Well, OPEC, I think, is trying to push a little. If you look at it, there is a narrative that OPEC is trying to crush U.S. shale. But if you look at the impact to the global rig count, including offshore rigs and so on, I mean, OPEC, through this strategy, is deterring some short-run and some long-run oriented capital expenditures. And so I think it's sort of clever of them to come out and do this as there's this tariff uncertainty, but in the face of a truly tight oil market, at least for the time being. And so in the face of that, they are sort of scaring off some of this capital expenditures. And what I think we may end up seeing is, to the extent that the global economy doesn't go into a very severe recession very quickly, especially with the tariff enforcement deferments, particularly the U.S.-China trade situation. It's not permanently normalized, but it's a lot better than it was a month ago. With that transition, I think we're still in this relatively undersupplied oil market. So sort of scaring capital into an undersupplied oil market, it's sort of brilliant. I was not so excited about this at first, but seeing what they're actually doing and then seeing some of the satellite data on OPEC exports so far in May, and then there's also the geopolitical risk with Iran that's probably worth mentioning, and with the various headlines there, where it does help. Look, the president was over there in the Gulf recently, and these countries, some of the countries that he visited were part of this group of 8. It makes sense that they would bring on some more supply, or at least some more paper supply, ahead of there being very difficult decisions for President Trump. And so I think they've shown, these countries within this group of 8, within OPEC Plus, have shown sort of an act of faith towards Trump, an act of good faith. And I think it's possible. I think there's more options on the table from a geopolitical potential oil supply perspective, supply risk perspective, than there would be if they hadn't been bringing on production. So again, there's this whole other aspect of that that's complicated. No one really knows what's going to happen there, but there is this right tail risk hanging out there, and we're sort of in this weird negative headline. Oil prices fall a lot on trade or tariffs or interest rates, and then geopolitical risk headline, oil prices bounce. And I just think all the sentiment is like way too negative, and we're still physically in this tight market. So until we see the market loosen substantially, until you see refining margins go, crack spreads in the U.S. were 27 last I checked, I think today. I mean, that's not a sign of that's not a sign of an oversupplied market. And I think we could actually be set up for a huge rebound in price and a real shift in sentiment as driving season progresses.
Okay, so looking out for driving season, looking out for some of these demand signals that you've also flagged, Josh, where should prices be at the midpoint of the year then? And what would you say is the top for the year? If the situation and the structure of the market is going to improve from here, where should oil prices actually be?
Yeah, so I won't pretend like my short-term crystal ball isn't broken. It's definitely totally out of commission. But when you look at just a fair price, if you look at the long-term sort of correlation of oil price versus inventories, the studies I've seen from a number of different analysts and research firms and so on indicate that the current inventory level versus the current demand level, ignoring sort of the supply or the trajectory, but just the pure inventory versus consumption, would indicate 85 or so dollar WTI oil, which is way higher than where we are right now. It's almost uncomfortable to say that, but that's the current price implied by inventories and implied by days supply from from that basis. So where should we be higher? When will we get there? I think as we get sort of more real trade deals that are more permanent, as well as some clarity, like you were saying, on the fiscal situation, some normalization on interest rates, even stabilization, where you don't necessarily need rates to come down a lot. You just need them to stop going up almost every day. And I think on the back of that, especially into what looks like a quite strong driving season, some of the early data, you look at Gas Buddy and some of these other folks, some of the early data for Memorial Day weekend and for some other short-term demand drivers look really positive right now. There's a lot of driving. There's a lot of indications of sort of discretionary oil demand here in the U.S. and abroad. And so, yeah, you could see 85 pretty easily just as fair value. And again, I think the bias is potentially to the upside, where if you go towards fair value, almost never in any sort of financial market do you get to fair value. Typically, you go from too cheap to too expensive. So I don't think we should be ruling out $100 oil this year. And I think if there is a geopolitical risk, it could get even higher. And I think if you just have sort of a normalization in trade, normalization in the economy, I think you could slowly get back to that sort of $80 or $85 level pretty easily.